Now we'll be talking a little bit about blockchain and cryptocurrencies. With us is Jernej Makovšek, CTO of blocktrade.com, and he'll be talking about building a cryptocurrency, a crypto asset trading platform. That's correct?
Correct.
Right. So please, if you could give it up for Jernej.
Okay, so thank you very much for the introduction. So I would just mention that if there are any kind of questions, and if it turns out that we don't have the time, I'm reachable at that address. So I can just keep the intro. So what would we talk about today? So we have an interesting project, and it's interesting from different points of view. We would go through some basic definitions and basic terms so that we all know what we're talking about. And then we would check the environment in different markets, in classical markets, and then as a comparison, check what's going on in the crypto markets, how they are different, and how we as an exchange, soon to be regulated exchange, approach those problems. And then we would see what types of clients are connecting to classical and crypto exchanges, so that we know what kind of requirements do we have from the implementation point of view. And then we will talk a bit about the implementation itself and about the future. So let's say you want to buy a share of Apple, Tesla, Facebook, Google. You will most of the time see a picture like that. So there is a group of people who are already having, let's say, the Apple stock, and they are offering it at a special price. And this price, of course, varies because let's say that this is my bit, and a couple of seconds later somebody else comes and he's in a hurry. He needs to buy a new car. So he drops the price, which is basically great for someone who wants to buy something. And if the match is made, the match basically produces a trade. So that's basically the place where you get your asset. Or so you now have, let's say, the one stock of Apple. So now you're in the market. And let's say for some reason, because a good buddy of yours, or you just read somewhere that it would be a great idea to invest your pension fund into, let's say, Facebook stocks. And so your assumption is that once you have the asset, basically not much can happen to you. But let's see what's happening in the wild. So what the market basically looks like, and what's the ecology of the market. So who is doing what? So what we are seeing here is basically a live picture of a market. Nanex is one of the more famous companies which are focused in studying and researching what is going on in the markets at a very small time interval. So we're speaking about milliseconds, microseconds, nanoseconds. And this is one of such events here. So if we just take a moment to explain what we are seeing. So the white towers are basically the trades. The height of the tower signifies the amount of the trade. So the higher the tower is, the bigger the trade was made. The red boxes are, of course, the price movement. And on the left and on the right, we have basically the bids and asks. So if the price, if the timeline goes from back towards us, we would think that the asks are here. So the people who are offering, let's say, Apple stock, and the bids, those are people who would be interested in buying those stocks, would be here. The color represents, and this is somehow important because we will study some similar charts later. So the color represents the number of orders in this price range. And the height of this, let's say, mountains represents the amount of those orders. So this is more or less a traditional view what's going on, and this is what would be the view of, let's say, 90 or more % of the time of what's going on the market. Because you as an investor would, of course, be interested to buy something low. So since this is pretty much obvious, a lot of people are doing that and sell, let's say, at a higher price. And that's pretty much obvious also. So, of course, a lot of people are doing that, meaning that the volume, the order amounts are, of course, larger when you are going, so the more you are going away from the price, the current price, the higher the order amount you would see. So yeah, you're now in the market and you are feeling, let's say, fine, satisfied, you have done your work. Yeah, so you have had heard something about this thing. The story is a bit larger. So the story raised several questions. Also, there was so the people have been brought to the Congress to talk about the issues. And if you have a chance in the summer, I would highly recommend those books. So you have done an investment in the, let's say, New York Stock Exchange. The stock exchange has, of course, some historical evolution based on the needs, and of course, the one that adapts survives. So usually, people started investing by studying the asset itself. So if you would buy, let's say, a stock of a company that has something to do with oil, you would go to their headquarters and check how much oil they would have. At some point, the traders or investors realized, hey, that's basically a lot of work. So why should I go and travel half of the world to check how much oil there is? I can just see this nice graph, the price, and draw some lines. And if the line goes up for, let's say, 3 days, it will, I am 90% sure that it will go up also the next 2 days. And this kind of abstraction evolved to the point where basically you aren't even interested in what's going on with the price, meaning the momentum, if it's going up or down. You have a set of abstract mathematical rules where you can be always profitable. One of the strategies for you to be always profitable can be that you are somehow influencing, let's say, less informed traders. And by doing that, you might intentionally or unintentionally send signals that might not be very true in the long term. So one of such acrobatics is called quote stuffing. So you're seeing that your investment is now suddenly not so safe anymore because you're under scrutiny from different interested parties which would do pretty much everything that they would be profitable no matter what's the impact for you. Okay, so let's try it that way. Okay, so let's go over the color coding again. We have here, again, a study. Here we have the resolution of a few minutes. And let's just see what's going on in the market. So this graph represents basically the order book. The white dots represents when the trade have been made. So whoever had made the bid and whoever had the best ask, those two have matched and a trade was produced. So the assets were exchanged. But please look carefully what's going on here. So, okay, so perhaps we should explain what those colors basically mean. So similarly as in the previous picture, the color here means the amount of the order. So the blue means, let's say, for example, 0.1 Bitcoin, and red means 10,000 Bitcoins. So those are the sizes of the orders. And you as an investor can do something like that. You can place an order, which as we see is quite large compared to everything else that's in the neighborhood. But with that, so what you signal with that is that you are prepared to sell a lot of, let's say, Bitcoins. But at the next moment, those orders disappear. So from one moment to another, what the market sees is, hey, there is somebody who wants to sell a lot of Bitcoins, so I suppose the price will go down. But in the next moment, which can be a nanosecond, microsecond, those orders are gone. But because the market has received that kind of signal, the price goes down. So the process, if we go back to the definition, the process of sending an order with the intention not to go through with the trade, but just to send a signal to confuse the others is called quote stuffing, and it's of course illegal. So for traditional markets, that's more or less regulated. But what you can see here, where we have gold features, so apparently a traditional regulated market, things like that still happen, and in a large amount. So this order amount caused such a signal that the market received it as that the price will go down. But if you check what's going on in the next minutes, basically the opposite. So somebody is sending large orders to signal to the market, hey, I would be willing to buy, but there weren't any trades made at this price point. So again, it was just a signal to somehow confuse the market or just to give a wrong signal. And that happens again here and here and so on. So here we see pretty much the details or let's say more granular dynamics of this part. So the size map. The color represents the amount of the total amount of trades on each side. So from the number upwards, the total amount is, let's say, 205 Bitcoins. And you see that in one moment, the amount rises of the orders. So somebody sends, let's say, an order for 10,000 or let's say 200 Bitcoins. And in another moment, that order vanishes. Because you as a market participant can, of course, say, hey, I would like to buy at this, and let's say at this price. Or you can also say, hey, I basically don't want to do that. Please cancel my order. If you do that repetitively, basically through the day or through the month, this is something that's called then quote stuffing and is highly illegal. For that purpose, so what are exchanges, regulated exchanges doing about that? They are counting the number of orders you have sent and the number of orders you have canceled. And if the ratio is right, you're okay. But if it's not, your trades can be canceled and your account can be banned or closed. Okay, so let's continue. So we're still in the classical markets, that is New York Stock Exchange. We're talking about gold features, Facebook stocks, and so on. So what also happens, so apparently there are some guys, some predators who somehow try to curve the rules, so they are pretty much on the edge, and by that they are somehow trying to confuse you in thinking that they want to do something they basically know that they will not do. As we saw previously, one such action was to place an order which the owner knows that he will not execute on. So what are other popular techniques which are also illegal? So what we have here, numbers of messages per second, which means that the exchange is receiving a number of orders. Let's say somebody is saying, hey, I would like to buy that. Another guy is saying, I would like to sell that or cancel that order. And we are here at about 6,000 messages. So, it would be good to mention, so as you see here, the negative scale. So the positive scale speaks about orders where we are placing them in the order book. Those are, hey, I would like to buy something or I would like to sell something. And the negative orders are about the number of requests people are sending to the exchange, which are saying, hey, please cancel my orders. So at some point you have in the order book, let's say 10,000 orders, and somebody says, please cancel my 6,000 orders. So what happens? Usually, and we will see later the comparison about performance of the basically the capabilities of modern exchanges, they aren't so stellar. And if you say cancel my 6,000 orders, that's something the computer has to work on. And we see that the computer has to work on more than 60 times something milliseconds. Which means that on the other side of the trade cycle, you have messages, what's going on the exchange, and people are listening. And at some point, when this happens, they see that for some reason, the orders, the messages, the activity on the exchange is a bit slower, but not because the real activity would be lower, but because their infrastructure isn't able to process such big changes in their order book. Now, why would that be important, illegal, and so on? There are different strategies how to basically do your investment. One is buy low and sell high, and there are pretty much more complex situations or strategies. And one of those strategies could be that you would listen to the market activity. And you could infer that if the market activity is low, that there is low volatility, which means that you are under lower risk. And there are a lot of such thought trains where you can construct a strategy. But let's just say that a lot of people are measuring the activity on the exchange. So when you do something like that, when you basically try to make a denial of service on the exchange, this hurts a lot of investments. And it is, of course, also illegal. But as we see, do we have a year here? Okay, we don't, but this is in the last 5 years. So that's still happening. So how the regulators resolve these cases are they are investigating it like for a couple of years, because of course they can't do it in real time. The exchanges have to notify the regulators that such events have occurred, and then they start with the investigation if this is really caused on purpose to somehow trick the other investors into thinking that the market activity would be lower, or if this is basically something that is proper, that it doesn't have basically bad intentions. So there are a lot of other things that can go wrong when you are in the market. So let's say you have now invested your pension fund into Facebook stocks, and so you had a good year. So the stocks went super high, and you want to sell. But because your order is, because you are now so rich that if you would sell, you would move the market price, you're thinking about, hey, perhaps it would be great if I wouldn't sell just on this one exchange, because I would move the price and lose, I don't know, $500,000. I would perhaps sell 100 shares on this exchange and 100 shares on this exchange, and so on. So the price on each exchange wouldn't be moved as much. So that's your idea how to liquidate the assets and buy a Mercedes, a new house, and go to Hawaii. So there are strange things happening also in the classical markets. One of the things is called front running. So when you are selling your 100 shares here, you have sold it all. So you liquidate your 100 shares. But for some reason, the next exchange where you are doing that, you don't sell all the 100 shares at that price that you have decided on to sell, but you just sell, let's say, 90 shares for whatever reason. And that's a bit strange, isn't it? Because your terminal is showing you the information that there is enough liquidity. When you have clicked on please sell my 100 shares, there still was the liquidity, but for some reason you don't get it. And it gets worse on the next exchange, and so on. So what's going on? There is a breadth of traders that is doing nothing else than thinking all the day long how they can profit. And again, whatever is legal, it should go. But let's just say that it took the investors quite some time to find what's going on here, and to say to classify it as illegal. So what is front running? As you perhaps remember, the exchanges have evolved. They aren't anymore the place where people would shout and run around, but basically the exchanges are nothing else than huge data centers. So you as an investor or a trader have an option to pay them, let's say, 100,000 euros per month, and they would place your machine next to their servers. So when you would click around and click on the bets exchange to sell your stock, and then you would click on the next exchange to sell your stock, and let's say you're pretty much so let's say you are clicking very fast, so you need only about what's that, half a millisecond to place your orders. So what happens is that on the first exchange, somebody sees that you have placed the order. And at that time, they are communicating already to the next exchange where they would sell their orders or cancel, sorry, not sell, but cancel their orders and move them to a higher price. So basically what's going on is that when you want to sell your 100 stocks, they are moving the price so that you get less or pay a higher price. So at some point, professional traders had it enough, and they came up with a solution. It's called Tor, and they found out in the first 18 months when they were talking with the other investors, professional investors, that this solution is basically worth $100 million. So they have sold the solution because that was the so the problem was so big that people were willing to pay such amounts of money just to get rid of this problem. And the solution includes that when you are diversifying your stocks, so when you try to liquidate on several exchanges, that you are doing it slowly but in a more synchronous way. So it takes the orders to land on different exchanges in less time than the, let's say, high-frequency traders can connect to the next exchange. And that's the current solution now. And of course, you get 100% fill rate. So you can liquidate all of your assets at the price you wanted to. Yeah. So there are things that aren't usual. There is a whole theory around it, and basically there are events on the market where you wouldn't expect it. For example, you wouldn't expect that the price of gold lowers by, I don't know, 50% tomorrow because it doesn't make any sense. But things like that are happening in the traditional markets. So we see here a market for, I'm not sure which asset, but we see here a pretty high spike. So this isn't usual, but it's still present. The other thing is that in some cases, the liquidity can evaporate. So somebody which had a lot of orders here would just at some point say, hey, please cancel all of my orders. But the thing is that black swan events aren't so infrequent as one would think. So with that number, one would get to about 10 per day. So the black swans are more or less getting wider. So what about crypto? So the fun begins. You can imagine everything that's going on the classical markets and more. So at some point, people can join a channel, let's say on a Telegram, and say, hey, on Saturday we will buy a lot of Bitcoin, and the market receives, let's say, this signal, and they think the price will, for whatever reason, go up. And they are investing, and the original investors are then at some point selling. So you wanted to do a simple investment, but you didn't know that there was a jungle out there. So how are we at BlockTrade solving this kind of problems? So we're trying to reduce the risk you are having as an investor, as a market participant, by being fully regulated, also in the crypto world. So we would be the first one to be fully regulated facility under MiFID and ESMA guidelines, which are saying that you as an exchange should follow what's going on the market and prevent market manipulations, especially the kinds we have saw. Now let's quickly go. Oh, I have to stop. Okay, can I have just 1 minute?
1 minute? Sure.
Okay. So we have, we now as exchange have some rules to make sure that your risk is as low as possible as an investor. So from the technical side, we have a lot of different types of requirements. So just to mention Siemens, which is doing basically time series analysis, but here we could see a newcomer, a simple investor, the professional investors, which are still clicking and sending orders by clicking on buttons. And at some point, we have high-frequency traders. So you can see here that basically tick-to-trade latency means that from the time we get the information from the exchange to the time when we can make a decision about if we will buy or sell, we can do that now in about 100 nanoseconds. So you can imagine how many decisions we can make per second. So how can we, as an exchange, handle things like that? The other thing, as mentioned, the exchanges have to evolve. And what has looked like this is basically now a bunch of data centers. So because of time restraints, I would just skip the problems we had to solve in order to basically came up with a solution, which is omega. So what is omega? Omega is the last letter in the Greek alphabet, but it's also our architecture. Because it basically allows us to scale and to process such huge amounts of number that it may well be the last system we need in the financial services. So just a quick view of what other exchanges are processing. So we are speaking about transactions per second. We are currently about processing about 2 million trades per second. So if we get 1,000 orders from the API, we can process them in about 200 nanoseconds. And yeah, so welcome to the new regulated financial world, and welcome to blocktrade.com. Thanks.